Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending July 15, 2022. Looking at the indexes for the week, the TSX was down, but the Russell 2000, S&P 500, NASDAQ, and Dow Jones were all flat or up slightly after a volatile week, where the end of the week recovered the losses from the beginning of the week. Oil and gold were both down once again for the week. Oil dropped below $96 per barrel, helping with the inflation problem. The Canadian strong jobs report and unemployment rate being lower than expected at 4.9%, an all-time low, the Bank of Canada was able to raise interest rates on Wednesday by 1% into a strong economy to lower inflation, bringing the total rate to 2.5%. There were 43,000 job losses, but about 100,000 people dropped out of the workforce, lowering the unemployment rate. They either became self-employed or retired. The wages are still increasing at 5.2% year over year, causing inflation and a tight labor market. In the US, the unemployment stayed a surprisingly strong 3.6%, which is beyond full employment. The bond market pricing suggests investors expect inflation to drop back to the 2 to 3% range within the next 2 years. It's not a slam dunk. They've certainly been wrong before, but there are some good signs. Central banks have taken big steps to fight rising prices, and we're already seeing things like freight rates and steel and copper prices go down, while retail inventories have been piling up. The Canadian banks are strong, high-quality businesses which have their share prices reduced by threats of a recession and a weakening real estate market, and are buying opportunities, in my humble opinion, with amazing yields as a result of the lower share prices. The Canada Housing and Mortgage Corporation says a recession could be in the cards by the end of the year as the Bank of Canada aggressively raises rates to tackle decades-high inflation. Canada's National Housing Agency says it would take increases to a 3.5% benchmark rate for the 2 straight quarters of negative GDP. In that scenario, CMHC expects home prices to fall 5% from the 2022 peak by the middle of next year. Sales would fall by an estimated 34%. If the rate rises to 2.5%, CMHC says growth would continue, but at a slower pace. The consumer sentiment in Canada is down very low, mostly because of the inflation which people see in the grocery stores every day. The Canadian consumer is highly indebted and is seeing their real estate value come down along with their portfolios. Why would they have good sentiment? Another yield curve inversion has happened in the US between the 10 and 2-year US federal bond yields. This is sometimes an indicator of future recessions, and it is being seen as a negative sign. On Wednesday, the 1% Bank of Canada rate hike, highest since 1998, didn't really shock the markets, even if it was higher than expected. The rate hike is intended to fight inflation and is front-loading the raises by being upfront. The sky-high inflation in the US of 9.1%, a 41-year high, also did not cause a huge market drop, but will possibly cause the US Fed to raise interest rates more at the end of July, possibly even 1%, which is already priced into the markets. It is likely to be at least 0.75%, and this is increasing the recession risk as demand is being decreased. The stock markets seem to be on the lower end of their range, and unless job numbers start coming in as bad, the markets will continue bouncing around the bottom of the range in a bear market in the US. The other thing that can cause markets to take another leg down would be if the Q2 earnings are worse than expected and there haven't been significant warnings yet as we go into earnings season. JP Morgan Chase, a major bank in the US, has reported a 28% drop in profits in the second quarter. The largest US bank's earnings fell short of analyst expectations, with net income dropping from a US 11.5 billion to US 8.2 billion, compared with the predicted drop to a US 8.5 billion. It is the first time the bank has failed to meet profit expectations since 2020, sending a warning sign to other banks. One major drag on the numbers, the bank had to bolster its reserves for bad loans, adding 428 US million as it girds for a rocky economy. Morgan Stanley also missed expectations on the top and bottom lines. This drove Canadian banks down as well, seeing the stopping of stock buybacks and increasing loan loss provisions and contingency funds into US banks. The Canadian banks report in August for Q2. The US dollar is on a 20-year high at parity with the euro. One Canadian dollar is 0.77 US dollars. Looking at real estate, condos are keeping their value better than detached homes because they are cheaper and therefore more affordable to current buyers. Real estate on both sides of the border is heading down, however. Turning to next week, earnings for next week, on Monday we have Bank of America, IBM, and Goldman Sachs. On Tuesday is Johnson & Johnson, Netflix. On Wednesday is Tesla and ASML. On Thursday we have AT&T and SAP. And on Friday we have Verizon and Twitter. The Canadian earnings haven't begun in earnest yet. Looking at next week's economic events, on Monday we have Canadian housing starts. On Wednesday we have the very important Canadian CPI, a reading on inflation, which the Canadian Central Bank will take into account the next time it is looking at raising interest rates. And on Friday we have Canadian retail sales. That concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.